name's Rob Crossingham. I'm a partner in the insurance team at Weightmans. I'm joined by my partners Alex Marler and Richard Palmer for what's the first in a series of 3 podcasts where we'll be taking a look at the Third Party's Rights Against Insurers Act 2010. In this first podcast, we'll be taking a look at the current economic landscape to provide a context for how the 2010 Act will impact upon insurers and brokers. In the second podcast, we'll focus on how the Act works in practice. And in the third, we'll highlight some strategic issues that may assist you when faced with claims under the 2010 Act. So let's start in this first podcast with some context. On the 23rd of March 2020, the UK economy and working life as we knew it was effectively shut down in the first of the nation's lockdowns imposed to slow the spread of COVID-19. The economic consequences of the government's response to the virus were stark and ruinous for many, with many thousands of businesses in retail and leisure in particular being forced to close their doors, and others having to adopt new working practices and new technologies almost overnight. There are probably very few companies, not just in the UK but worldwide, that have not suffered some form of business interruption as a result of the COVID-19 response. So with the lockdown and the enforced closure of business as we knew it, the government rapidly introduced a package of support measures, including, of course, a furlough scheme, as well as a variety of short-term business loan schemes and other measures that we'll look at. At the same time, concerned about widespread business failure and corporate as well as personal insolvency, the government introduced emergency legislation in the shape of the Corporate Insolvency and Governance Act 2020 to block the debt enforcement procedures usually available to creditors of defaulting companies. It also introduced measures prohibiting landlords from evicting tenants for non-payment of rent. The initial suspension of these debt enforcement measures has now been extended to the 31st of March 2021. So what evidence do we have as to the current conditions out there for business against that backdrop, and how, by and large, are they holding up? We'll talk about the FCA Financial Resilience Report in the specific context of the FCA regulated regime later on in this podcast. For now, looking at the wider commercial sector, in January 2021, the Federation of Small Business reported on the findings of its Small Business Index survey, reporting that 250,000 small businesses were facing life or death in the next 12 months, and that there are now more than double the number of small businesses and SMEs at imminent risk of failure than there were in 2019 before the pandemic. Although the underlying cause of this situation is obviously the government's measures to contain the pandemic, in fact, the Federation of Small Business report is clear in blaming what it says are inadequate support packages for SMEs across the spectrum. While the FSB report and many other commentators are painting a particularly and unsurprisingly bleak picture of the outlook for UK SMEs, we haven't yet seen reports of a deluge of insolvencies, perhaps in part due to the interim suspension of insolvency and debt enforcement procedures that I touched on. But there are other dynamics at play, and I think Alex is going to talk about those.
Yes, thanks, Rob. Well, first let's look at what might be on the horizon in terms of the government-backed loan schemes and other support measures. Those loans are provided by the government-owned British Business Bank, and that reports that as at the end of October 2020, more than 1.4 million businesses had obtained government-backed loans with a total value of around £62 billion. Now, many of those loans had interest deferred for the first 12 months. That means, of course, that businesses who took advantage of the scheme early on, so from March last year, now face the prospect of interest payments starting in the coming weeks. But in many cases, their businesses will still be closed and revenue will be low or non-existent as a result of the latest lockdown, which of course wasn't foreseen this time last year. So those businesses and others with other kinds of short to medium term funding arrangements coming to an end will need to give urgent thought to recapitalising to remain viable beyond the very short term. But they'll face the challenge, I think, of demonstrating to lenders that their business is a going concern and a decent risk to lend money to, when their staff overheads are for the time being very heavily subsidised under the furlough scheme while that remains in place, and no normal revenue stream whilst still forced to close. and even property assets might be difficult to value until the economy rebalances. But this might not all come to a head just yet. A number of commentators and credit brokers expect credit markets to remain soft for a number of years, so businesses might yet have ready access to credit, despite the problems with their own businesses and the wider distressed state of the economy. So that might give a lifeline, at least in the short term, but it's still a stopgap. One commentator notes that ample financing would allow structurally weak firms to survive, even though longer term prospects of profitability appear dim. We may end up with a universe of companies limping along for the next 5 to 7 years just because credit markets keep them afloat. And if that prognosis is right, we can see quite a long tail impact from the pandemic, perhaps rather than a cliff edge, as well as negative implications on commercial innovation and competitiveness. And as mentioned, many businesses are still taking advantage of the furlough scheme, receiving heavy subsidies for the cost of retaining their staff who aren't currently needed. Businesses have already faced significant disruption and administrative costs and some risks in implementing those schemes. But the furlough scheme will come to an end either in April or after any further extension, and businesses will then face a stark return to pre-pandemic overheads, but in many or most cases without a matching return to pre-pandemic revenue. So we're already seeing the signs of a potential logjam of business failures on the horizon, though it's not quite clear how far away that horizon currently is. So let's now turn to the short-term measures that were introduced to block insolvency proceedings under the Corporate Insolvency and Governance Act 2020. Could I turn back to you, Rob, to tell us a bit more about that legislation?
Yeah, sure. Thanks, Alex. As I mentioned earlier on, the government's emergency legislation effectively prevented creditors from presenting winding up petitions against defaulting corporate debtors. And although there were some limitations on that, it largely suspended the contentious insolvency process in the English courts. And again, anticipating that these emergency measures will come to an end at some point, this would suggest that there are grounds for expecting a backlog of corporate insolvencies on the short to medium term horizon as soon as contentious insolvency becomes available again. What's interesting about it is that perhaps a corollary of these emergency measures has been a significant increase in the numbers of voluntary liquidations, with Q3 in 2020 seeing a 52% increase in corporate voluntary arrangements over the previous year. This might in part be due to businesses simply choosing to fold now rather than prolonging their agony and effectively bowing to the inevitable. But in reality, commentators have reported that the reason behind the increased use of voluntary insolvencies are likely to be more nuanced and sophisticated, with some businesses taking the opportunity to reinvent or streamline themselves, divesting themselves perhaps of commitments in the shape of premises, infrastructure or staff. Many businesses will no doubt be reinvented, having dumped toxic assets and exposures, having made block notifications to liability policies, phoenixing into new business. And that's something that we've already started to see reported in the financial services context. Further, that many will be anticipating a tightening of the UK tax regime in order to fund the government's coronavirus support measures. And in particular, commentators are already focusing their attention on the likely reforms and tightening around capital taxes and CGT, which in fact are taxes which are capable of being avoided or mitigated within the context of voluntary insolvencies. So whilst the increase in voluntary insolvency may on first sight appear to be the result of businesses bowing to the inevitable while contentious insolvency is not available, in fact, there are a number of factors which point to them being an astute option for many SMEs. So that's a high-level overview of the current economic context and some of the nuances of the economic impact of coronavirus. We'll look at some specific sectors now, directly within the scope of our practice. Richard, I think you have a particular focus on risks, liabilities and disputes within the construction sector. What particular issues are you seeing there in terms of business resilience and insolvency?
I think, Rob, it's fair to say that over the last 3 years or so, there have been a number of challenges to the construction industry. In 2017, we had the awful events of the Grenfell Tower tragedy, and that shone a light on practices adopted by an industry often focused on value engineering, saving cost over saving lives, if you like. This prompted Dame Judith Hackett to say in her Building a Safer Future report that there was a need for a radical rethink of the whole system and how it works. Cladding claims have become commonplace when, prior to 2017, the majority of cladding claims that we saw focused much more on water ingress than on fire safety issues. In 2018 came the collapse of Carillion, an industry giant on whom so many small to medium enterprises and specialist subcontractors relied for significant amounts of their work. And then in 2020, as you've alluded to, came COVID, causing many construction sites to stop work, and when they started again, requiring different ways of working. So it hasn't been easy for the construction industry. The insurance market has also hardened in those intervening years, with capacity reducing, rates increasing, exclusions, particularly fire safety and cladding related, come into the fore, and a move away from an each and every claim basis of cover to aggregate limits and significant policy excesses being imposed. In terms of business resilience in the construction industry, as you know, there's usually a delay between work being performed and payment actually being received. Most contracts provide for staged payments in arrears, resulting in the supply chain carrying significant work in progress until it's paid. This lag can result in businesses suffering cash flow issues because they have to wait significant periods for invoices to be paid, or in some cases, they may not be paid at all. And these are the main triggers for insolvency. Lack of profitability can also affect construction businesses of all sizes. The sector contributes approximately 7% of GDP, meaning that it's a large and therefore highly competitive industry. Tenders are often decided, certainly historically, on price, meaning the lowest tender often wins the work, and you have this race to the bottom, resulting in contractors performing work with minimal margins. Any unexpected delays or increased cost in the work which the contractor has to bear, for example, high material or rising labour costs, can wipe out any profit from the work. And that's in addition to the domino effect that we talked about with Carillion and we saw in 2018. So taking all that into account, it's perhaps unsurprising that in 2018, the construction industry had the highest number of insolvencies, losing more businesses to insolvency than any other industry in 2018. And more than any year since 2013, as reported in the Building magazine. According to the Gazette, the construction industry group again saw the largest increase in underlying insolvency volumes in 2019, and in 2020, even prior to the full impact of COVID, so during the first 3 months of the year, over 700 construction businesses went bust. We've again seen further high-profile casualties in the industry later in 2020, notwithstanding the provisions in the Corporate Insolvency and Governance Act that you mentioned, Rob. I expect that pattern to continue, and of course we've yet to hear the outcome of the Grenfell Tower inquiry, whose findings are not expected until at least next year. That's not to say it's all doom and gloom, however, and as always, underwriters will always be interested in ensuring the best managed and most financially resilient businesses in the industry, but premiums are going up and capacity is reducing. The construction playbook launched in December 2020 outlines what government expects to come from the construction sector, from new roads and railway lines through to schools, hospitals and prisons. And the playbook also outlines the key role the construction sector will play in both the UK's recovery from the coronavirus pandemic and the work to bring greenhouse gas emissions down to net zero by 2050. Green initiatives in the playbook include promoting the use of carbon assessments to understand and minimise the greenhouse emissions of projects. And no doubt learning lessons from the Grenfell Tower tragedy, the playbook also makes it clear that the construction sector must put safety at the heart of everything it does. We've also seen that with the introduction of the draft building safety bill as well. In terms of claims, one of the very current scenarios we're seeing is in the construction and particularly cladding market. We've seen a willingness on the part of building owners in some cases to invite contractors and construction professionals to be part of the remedial solution where non-compliant external materials need to be replaced on buildings. That can offer insurers greater control over the remedial process, and the insured may be prepared to carry the work out at non-profit rates. In contrast, if a third-party contractor or professional is involved, then costs are inevitably going to be higher, and those increased costs are going to fall at the door of insurers. As insolvencies in the industry hit, forcing contractors, specialist subcontractors and construction professionals alike to exit the market, then the ability of those parties to carry out remedial cladding schemes also disappears, and so insurers are likely to see increased exposures in this area. I'm also seeing an increase in the number of construction-related claims being intimated and brought directly against insurers by virtue of the third party's rights against insurers legislation. And I know, Alex, you're going to talk about that in a minute. But before you do, Rob, what's the picture around insolvencies in the financial services sector? Is that similar to the construction industry?
Thanks, Richard. In the FCA regulated sector, the picture is pretty gloomy, particularly for SME businesses operating in the sector, including IFAs and especially insurance brokers. Of course, in terms of understanding precisely what's going on, we now have the benefit of the FCA's January 2021 Financial Resilience Survey, which publishes the results of a survey of 23,000 FCA regulated respondents between June and August 2020. So there's a bit of a lag on that data, and the FCA is in the process of doing another survey at the moment. But the January 2021 survey found that a significant number of firms will fail over the next 12 months. And it identified 4,000 firms having low financial resilience. Those firms at most risk were predominantly SMEs again within the FCA sector, with the FCA finding that 30% of those most at risk would cause consumer harm if they were to fail. Interestingly, insurance brokers were in some of the highest risk categories. Our own experience of dealing with claims and advising liability insurers in the sector certainly corroborates the FCA's findings at the moment. In particular, we've direct experience and have also seen a number of reports in the industry press of IFA firms choosing to place themselves into insolvency, particularly those FCA firms involved in high-risk areas such as pension transfers, and they're facing a high volume of claims and false complaints. In many cases, those practices will have been unable to obtain insurance on their renewal, and so have tended to make wide-ranging block notifications before entering voluntary insolvency, and some starting anew with a Phoenix company. That's a specific example, but within the FCA regulated sector as a whole, there seems no doubt that we will see a large number of businesses failing, particularly, again, as I said, SMEs in the sector, and that both liability insurers and the Financial Services Compensation Scheme will take the hit. That said, interestingly, in the last few weeks, we've seen the FCA taking direct legal action against directors of failed firms, alleging misfeasance and misconduct in the business prior to an insolvency, amongst other things. We might well see more of that as the next few months unfold, and that, of course, will be a concern for D&O insurers as well as PI insurers facing 2010 Act direct claims arising from defunct IFA firms. So I think there's lots to watch out for in the FCA regulated space. Whilst there's probably not time to dwell on it at the moment in this podcast, it obviously goes without saying that the accountancy profession will be heavily impacted by insolvencies in the wider economy. Some firms specialising in insolvency, business recovery and perhaps tax mitigation will certainly be kept very busy indeed, facing operational resilience challenges themselves, and others, perhaps not doing quite so well, may well become distressed. Alex, I think you've been looking at how the economic aftermath of the pandemic, and in particular insolvency, might affect the insurance market. I know you're going to come on to look at the legal issues in more detail in a later podcast, but can you give us an insight into the general context in the market on these issues at the moment?
Yes, thanks, Rob. I mean, the pandemic is, of course, already having a major impact on businesses and a knock-on impact on insurers, but to an extent, I think we're still in the calm before the storm in terms of the greater fallout for insurers, and the future's still very uncertain in the ways we've been touching upon. When and to what extent will the vaccine rollout help return things to normal? How long and to what degree will government support go on? And how will that fit in with the ending or the easing of lockdown and other restrictions? Despite the government support, perhaps relatively easy credit and some help from business interruption insurance, though the vast majority of businesses didn't have such cover, businesses are going to go under still. And when problems later emerge in relation to the goods or the services that they provided, before going bust. Claims can be made directly against insurers under the Third Party Rights Against Insurers Act. So I think that insurers are yet to face the majority of the fallout from the pandemic, and that the claims will come in due course. Businesses have had to try and make things work under some very difficult conditions, no clear precedent on what they should be doing and how to go about it. Circumstances and rules have been fluid. And in that context, and with businesses often understaffed, struggling to balance competing interests, and there will have been mistakes made. Projects will have gone unfinished or not have been finished as they should have been. And there'll be professional negligence claims arising. There'll be claims against directors and officers of businesses, as Rob touched upon just now, with those people having had to make very tough decisions about their businesses and take action or not take action in tough circumstances that will now be scrutinised in the cold light of day, and there'll be D&O claims. All this will take time to come out of the woodwork. When it does, there will be some real challenges for insurers defending the claims that will be brought directly against them. So, having today looked at the current conditions and where it might all go and the scope for that to cause claims against insurers, in our next session, we're going to look at the Third Party Rights Against Insurers Act in a little more detail, how it allows claims to be brought directly against insurers, and also the mechanism for obtaining information to find out whether such a claim is actually likely to be worth attempting. Then in the third and final session, we'll get into the challenges in dealing with such claims and how to surmount them. So thank you for joining us for this session, and we hope you can join us for the next two.